Good morning, everybody. Kirk Spano and Dave Zanoni. Do I say your name right?
Morning. Oh, yeah, perfect. Yeah, put
Perfect.
a little accent,
Zanoni.
a little
All right.
Wisconsin accent.
Zanoni.
Yeah,
There
yeah,
you go. Two presumably Italian guys.
yeah.
I'm Sicilian, so that makes me
Okay.
the grubbier of the
Yeah,
two.
yeah. I'm more from the northern part
Yeah, yes.
of my.
You, you, uh,
Mhm.
you very fashionable Northerners.
Yeah, yeah,
The Milan crowd.
yeah.
All right. Um. So was it? Is it only February 1st?
That's it.
Where's my groundhog? Groundhog tomorrow, huh?
Yeah.
All right. All right. So the services are fundamental trends, margin of safety investing. Pretty soon we're going to have investor ideals, which is going to be sustainable investing, which is where my investment firm go? Oh man, look at that. There you go.
Okay.
Sustainable investing and change. So I have been in the process of converting my investment firm in this direction because even though you guys all know me as an oil bull, I think that was just a reality of the world. It's not because I had a predisposed. You can always talk to my eyeless chat bots here. I'm
Mhm.
trying to give her eyes. I mean, I guess there's eyes in there, but can you see eyes on her?
Hmm.
I don't know.
It's too small to see.
Yeah, I know. I think I might change her to a brunette too.
Hmm.
So anyway, I might make him a little butler dude. So anyway, the reason why I've been moving towards this direction is one, I think, I'm one of those climate change believers. Not a religion thing. It's just the evidence to me over 25 years is pretty irrefutable. Um, but when you apply it to the core four approach, which is to consider the macro trends and the government trends, government policy, you can see that corporations and individuals favor doing something to mitigate climate change, and government policy has moved in that direction too. So when the macro trends and the government both change policy, both head in the same direction, you got to really think about that. So my investment firm, like the Investor Ideals website that'll be up in a few months, and the FA Trader, we'll talk about that in a second too, investment service that I'm going to be launching with Avi Gilbert here in the next month, focuses on these big trends. So I think it's important that we think these things through in long-term concepts, because having your asset allocation tilt directions or in many of the right directions is actually going to be very, very important over the long term for your portfolio. So we get all caught up in 3 months and in 1 year and in 2-year periods of time. But the reality is we really should think of the next decade. What is going to be the big changes in the next decade? What are going to be the big trends in the next decade? And if we focus on a decade rather than a year or a quarter, we're going to do much, much better with our investing because our asset allocation will be tilted away from the things that are going to experience headwinds and tilted towards the assets that are going to experience tailwinds. And just that change right there, just that tilting of your portfolio towards 1 or 2 or 3 areas and away from 1 or 2 or 3 areas, and then several sectors being neutral, you're going to make a lot of extra money. There is a study 15, 20 years ago now. You've all seen that asset allocation accounts for 93% of your portfolio performance. They don't define what portfolio performance is there, however, and other studies have shown that asset allocation is closer to half of your portfolio performance, the other half being security selection. Now, I believe that it's closer to half, and here's why. The definitions, right, the mundane definitions of what asset allocation affects are different in each study. So the one that comes out saying that says 50% of your performance is based on asset allocation and 50% is on security picking, that's really based on performance. that's how much money you'll make. The study that you've seen where it says 93% of your portfolio performance is based on asset allocation, that was a way for the industry to sell you mutual funds and eventually ETFs, because they're not really talking about performance. They're talking about volatility. So your asset allocation will determine 93% of your volatility, but not 93% of your total return. Aha. I mean, that's a huge distinction, don't you think, Dave?
Definitely.
I mean, did I make sense? Does that make sense the way that I explained that? Anybody in the chat get that? Already people talking about the 2020 elections. All right.
That should be interesting.
So folks, how many of you have a financial advisor and they talk about asset allocation, but they don't really talk about what I just talked about in 2 minutes, right? They talk about, well, 93% of your returns will be asset allocation. They're trying to de-emphasize security selection. Why? We've talked about this too. Certified financial planners have no clue how to pick out investments. Zero. They're not trained in it. CFP, Certified Financial Planner, does not train you to be an investment picker. It trains you to write financial plans. And there's a value to that, but you can go to mint.com and any number of free websites, and for $20 or $99, you can get 90% of what a financial planner will do for you. The only reason I think anybody really needs a financial planner is if you have more complex needs. For example, you have to incorporate a family business into your planning. You have some more complex tax or estate planning, but I will give you the secret to financial planning. This is financial planning 101, 201, 301, 401, 501, probably even 601. It might even be master level. Here it is, Dave. Here's the secret to financial planning.
Got my pen ready here.
Can you guess what it is? Can anybody put up there? What is the secret to financial planning in your household? It's one sentence.
Save money. Spend less than what you make.
Spend less than what you make by about 20 to 25%. So I've told my kids, and I've told everybody I can tell. I told so I was on the way back from the casino. Okay, so here I'm gonna confess my sins. Yesterday I played in the World Series of Poker in Milwaukee, and I ground my way through 2/3 of the field, and then shoved a big hand into another big hand, and I was trying to get him to fold. And if he didn't fold, then at least I was a coin flip to win, and I lost, and I was out. But, so I went and visited a friend who just got a job at the Potawatomi Casino in Milwaukee, played a little blackjack, made $35, left, and then I went and grabbed a burger on the way home because I hadn't eaten all day. And I stopped at a little neighborhood bar called Muggsy's, if you're ever in Muskego, Wisconsin, a nice little dive bar, and grabbed a burger. Well, the cook was off of work, so the bartender made it. I'm sitting there talking to the cook because I got there late. And she has a public relations degree. And we were talking about, she was like, Kirk, I got this degree, and I can't get a job, and I make way more money tending bar and, collecting tips than I do, going to get a PR job, because they all want 3, 4, 5 years of experience. And how do you get experience? Same old thing you hear every kid say, right? And I said, well, you might have to go take a $15 an hour job to get experience, and then do this at night. She's like, yeah, that's kind of what I've been thinking. And I just did take a job for like $17 an hour. Not doing what she wants to do, but it's money, right?
Step in the door.
Yeah. Well, it's not even a PR job. It's just but it's a regular daytime.
It's bringing in some income. Yeah.
Well, and it's good for her resume, right? I mean, if you have on your resume after you graduate college for more than a year or two that you've been in the bar industry, they're gonna say, here's a bartender with a degree. There's nothing wrong with that. But I tell you what, I know bartenders. I know one girl graduated from the University of Wisconsin-Whitewater with a business degree, and she's been tending bar for 15 years now. and she makes 100 grand a year. Why?
Mm-hmm.
She got experience in it. She's good looking, and that has
just
something.
A lot of tips. Yeah.
Yeah, and she makes tips, and she, she goes to the right places.
Mm-hmm.
But not everybody can do that. So in any case, we were talking about what were we talking about, Dave? You got me off track.
You're talking about Investor 101.
All right,
Financial advising 101.
Yeah, I'm just making sure that
Mm-hmm.
you're listening. So anyway, she's like, I did get this one opportunity. I said, what was it? And she goes, well, Foxconn, which is building in Wisconsin, not really a factory anymore. Now it's going to be research and development with very small scale manufacturing. She goes, but I would have to go to Taiwan for 2 months to train. I was like, well, that's awesome. She goes, I don't want to go to Taiwan. I go, what do you mean? She goes, my husband would never survive without me for 2 months. I said, what? She goes, you don't understand. When I went on a girl's vacation, after the 6th day, he was like, I can't find food to eat. I don't know how to do the laundry. I was like, you know what? You need to train him, and you need to go to Taiwan because that will, that will be great for your resume. And I asked her, I said, could you just pay all your bills 2 months in advance and then be done with it? And, she told me some life things about her husband's gambling a little too much. See, there's a difference between gambling and playing poker. Gambling is when you lose. Poker is something where you stand up and walk away from the table if you're losing. So, most poker players don't gamble. They take calculated risks. They just lose. Mm-hmm. They just lose a lot. Mm-hmm. But I break even on poker. I pays for vacations. But most people are slow losers, but it's entertaining, right? So then they're paying for entertainment. Her husband actually pumps money into slot machines, and as anybody can tell you, Las Vegas was built on slot machines. So in any case, I said to her, I said, how much of your money do you guys save month to month? And she goes, what do you mean? I go, how do you guys save more than you make? She goes, yeah, he actually makes decent money. Between them, they're probably making 80, 90 grand a year, which isn't huge, but they don't have kids. And I said, you guys ought to be saving a quarter of that. And she's like, what? I go, yeah, you guys got to learn how to live on like 3/4 of your net income after taxes. And it just blew her mind that I said that. And I said the other thing, you need to save enough money to take, if you really got this Foxconn offer, you need to go to Taiwan because that's just a great opportunity. Go overseas, throw that on your resume. Even if you only stay at Foxconn a year or two, now all of a sudden you've opened up this world that you want to be in. Mm-hmm. But it comes down to, one, she had to save enough money to be able to pay the bills so she could leave for a couple of months and presumably buy, one of those companies that send food to her husband, buy one of those services. But in any case, financial planning 101, spend less than you make. And I try to tell millennials this and everybody else, and save about a quarter of your money, 20-25% of your money, and you will get ahead really, really fast. All right, so let's move on to what everybody really wants to hear about. If somebody says financial planning includes insurance protection, you really want cheap insurance to cover all the major things. We could talk about that another day. But term life insurance, folks, term life insurance, unless you have an estate planning issue and a tax issue, term life insurance. You don't need whole life or anything like that. I mean, I have whole life now, but I just bought it, and I've been insurance licensed for 25 years. So, I've been selling term life insurance for a long time. I've had, my $1 million and $2 million term life policies, but I just did whole life in the last couple of years. In fact, I didn't even sell it to myself. I went to Northwestern Mutual Life because, they're one of the 2-3 best life insurance companies out there because they have what is called a true participating whole life. So I hate to do an advertisement for Northwestern Mutual Life, but they're a Milwaukee company. They do good things here. And participating whole life, if you're going to buy whole life, because you have a tax and estate situation that you have to deal with, participating whole life is the one to go with. So I actually have some NML agents if you need to talk to one. But for most people, term life is the way to go. Sometimes there's a second to die life, makes a lot of sense too, but I'm single, so I didn't need that. In any case, who wants to talk about investments? Anybody? 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 Key to financial success. Somebody says, never take financial responsibility for anything that eats or floats. Oh, yeah, yeah. Well, okay. So what's the joke? What is a boat? What's a boat? Come on. Come on. It's a hole that you pour money in, your money into the water. Yeah, no, I love boats. I was just down in Florida, but I don't think I'll ever own one. I'll rent when I need to. All right, so people were asking about Antero Resources last week. So let's go through a whole bunch of investments today. Let's really tear apart some of the technicals of these companies and talk about things. And we're going to finish off with the employment report and a little bit about the slow growth forever economy and inflation versus deflation, because it'll play into some of these stocks and how we think about them. But Antero Resources, natural gas, one of the best natural gas companies out there. They had a substantial institutional seller that closed out a position, right? And so the stock got beat up. I have seen this in the past before, where a giant institution has to sell for some reason, or some key shareholders have to sell, and that's what happened here. So it was, I'd have to look it up, but it was a couple of guys, and then the company they worked for, who helped bring these guys public 15 years ago. It was that company. So they took their profits, they sold, and they sold mainly in here, but the momentum of the short sellers and people going, oh my God, it's going down, I got to get out. I don't want to lose everything, right? Because they have no freaking idea, right? They have no freaking idea about their companies. So this was an institutional cashing out, and then people started to panic. Oh my God, it's going to go to zero. It's not going to zero. It's going to go back up to 18, 19, 20. And it's going to happen in the next year or two. So if you want a stock that's going to double for you in the next year or two, Antero is a pretty darn good company to get into, because, like I said, it's natural gas. Demand for natural gas is going up. The supply of natural gas is flattening out again because the boom in shale is starting to flatten out. So all the associated gas numbers, it doesn't mean it's shrinking. It doesn't mean it's not growing, but it's growing less. So supply in natural gas is going to grow less going forward. But demand is going to keep going up. And I'll tell you what, you want a potential catalyst. Here's a potential catalyst. What if the Democrats get into a position to put more pressure on coal? What if China and India decide to make a giant push to get rid of coal, which they've hinted at, they've nosed around that, they've slowed down the growth of coal, they haven't got rid of it. What if in the United States we decide to stop exporting coal? That would be interesting, right? And I think that is a discussion that's going to be had in the next few years. If the United States stops exporting coal sometime in the 2020s, that means that coal in America would get dirt cheap. But at the same time, what if there's a law that says to the utilities, you have to cut your emissions in half? These are things that are probably going to happen. So you can't look at it from the standpoint of, well, I don't believe in that, so therefore I'm not going to think about it. Look, I don't care if you don't believe in climate change. I don't care if you're a Republican. I don't care if you're a conservative, a liberal, a Democrat, a libertarian. I don't care. But the trends are towards regulating fossil fuels more and cutting emissions, and the corporations are already doing it, and the institutions are pulling money out of the system for fossil fuels. How do we know that? Over 1,000 institutions have already divested their fossil fuel investments, and that's a headwind to these oil and gas stocks that we have, which is why I don't talk about them as being long-term forever things anymore. I talk about them as being a trade. And we also know that there's been no new debt issued for oil stocks in the last 3 or 4 months. Zero. Normally they go and they refinance debt all the time. Wall Street and the banking system is not refinancing, is not giving more debt to the shale industry in particular, because they already saved the shale industry. the shale industry that exists right now are the survivors from the crash from a couple of years ago, right? So, and you're getting consolidation in the system. Right? Chesapeake Energy's had consolidation. Who did they buy? Newfield or somebody else?
No, Encana was the one that had.
Yeah, Newfield and Encana. Chesapeake bought somebody down there. There's a bunch of Permian stocks that have been bought or merged. Concho merged with RSPP. You go right down the list. All sorts of consolidation. So, your little wildcat companies can't get off the ground anymore unless they have cash because nobody will loan them money. Exxon has eaten a couple companies. Chevron's eaten a couple companies. So, I mean, there's clearly a reason why we're near the bottom again in oil and gas in the intermediate term. Long-term, oil and gas are both going to go away. For gas, it's way down the road, 30, 40, 50 years. But for oil, by the 2030s, demand for oil is going to start falling. I don't know if it's 2030 or 2039, but it's in that range. Tony Seba says by 2024. I don't see that. But in my article on Tony Seba, $25 oil is out there. So go ahead and read that. But, we take a look at these investments and say, okay, so on an individual investments, what type of risk are we taking? Well, the risk that we're taking with Antero is that the divestment of fossil fuel investments in general is just so heavy that even if the price of gas goes up and these guys are hugely profitable, we're never going to get a valuation, right? That's, I think, what people ought to worry about is, can we get a valuation? And I would think that we'll be able to price to book value. I mean, way under 1. And that's why I say I think the stock at least goes back to book value. They're not particularly high debt because they do hold some cash. So as the price of natural gas goes up, they get over this selling by the institution. Do I see them breaking out into the 30s or 40s? I don't know. I doubt it. But I do think that this is pretty much a double in the next just couple of years. So I'm actually willing to buy some calls. I'm not buying a lot of calls right now because I do think the market's going to be choppy in general. And I've been telling people that for months now. Be real careful about where you're buying calls because the calendar may not be on your side if the market's choppy for 2 years, which is next 2-3 years. I think we're going to be choppy. And we might even get that crash if they screw up the China trade deal, although big China trade news, it's not overnight, right? So they agreed to buy a ton of soybeans, right? And I think natural gas too. Did anybody take a look at that headline? I didn't get a chance to read it.
No, I didn't see that.
I know there's big progress. So, where does this go? This is a big slide down. You've got money flow coming back in after the sell-off. MACD got positive. And it's kind of weird, right? It didn't go negative again. It just kind of leveled off for a little while. I think we're going to get these wavy, I think there'll be a rise here, starting in the not too distant future. And you'll look for this shape where it kind of flattens before it goes negative. It doesn't happen very often. So let's take a look at 3 years. Where does it happen? Would it happen in January? Seems to happen in January.
Is it correlated with natural gas?
I think
the price of natural gas.
This is money flow,
Yeah.
right? So where would money be coming from in January? We've talked about this. Anybody?
Yeah.
Anybody? Where does money come from in January for the market?
That's all the 401k money and all that.
That's right. A lot of retirement plan money. So I think this is just kind of natural what's going on here. They haven't quite gotten to where you'd expect them. Look, they can get way up here. So I think you're probably, nice upward bend, higher higher lows. I think this is getting close to breaking out. So I would be taking a look at Antero if you want pure natural gas exposure. So that's what these guys are. So all right, what other companies in our oil universe and gas universe do we want to look at? Occidental is one that I said this is the one that you should be replacing Exxon and Chevron with. Again, same thing with these guys. They're not where they can get, right? This is where they can get to. They're not there yet. Not overbought. Been trending higher. If you take a look at longer periods of measurement, bottomed out in the fourth quarter, and now it's going higher, but it's not as high as it can get. So I think what this means is you buy the dips on almost all of these, right? So you get a little dip, buy it.
Mm-hmm.
See, does the mouse? I'm trying to make that shape. She gets a trailer thing. She set up the trailer so it leaves a line, right? Yeah, I think maybe I'll set that up. Who else? Devon. So these are the stocks that I said this week are the ones I'd be looking at. I really like Devon. I think they're going to break out. I think they go all the way up to about mid-30s pretty soon by summertime. I think by summertime. I think you make 50% on this by summer. This one shot up, so you got to kind of buy the dips here. So, you know, let it do one of these things where it comes back down, then it shoots back up. Look at a 5-year chart. You know, you had all this garbage, the price coming down.
Oh, yeah.
So starting right about in here, take a look at the patterns. So it kind of needs to dip a little bit, right? Let it dip. Let it dip. You're not jumping right now, but I think this is something that you can get a piece of as it gets down here. Like this gets wavy and then goes back up. This takes a little dip and then goes back up. I think almost across the board we're going to see that. And Kana, the one that I think has the most total upside for a number of reasons. I still think it's going back into the 20 range. So this is a potential triple in the next few years. And I think that they're just I think these guys are just going to throw in the towel and let Royal Dutch Shell buy them or something, or Chevron or somebody, or Exxon. Exxon and Chevron, I think, make a lot of sense for these guys too. It's not just Royal Dutch Shell. I talk about Royal Dutch Shell buying Encana because they talked about the exact assets that Encana owns. And now that Encana bought Newfield, they have a couple other assets that they can sell. So they completed, you know, they added Stack Scoop. They have some Bakken holdings which are for sale. When those dollars, you know, when the market finally goes, oh look, Encana just dropped $1 billion to the bottom line. They'll go, you know, maybe I should take a look at Encana. So again, buy this dip, I think, because I think technically it's starting to go in the right direction. When you take a look at the weekly starting to move in the right direction. But just remember, long term, oil stocks have headwinds, and we have to respect that. But you know, the fundamental picture on oil. You know, there was an article on Seeking Alpha this week, and I commented on it. It was just an idiotic article, but it got editor's choice and a bunch of the bears jumping on it. I'm like, look, the thing with oil is that if money doesn't finance new construction, where is the new production going to come from?
Yeah, it has to be sustainable. Yep.
Right. So, you know, I think that we just have to.
Got to have the supply-demand balance.
Excuse me.
Yeah.
I just muted everybody because I heard some scratching going on. And I had to make you co-host because I had forgotten to do that. So, in any case, I think you can buy the dips on these energy stocks, but you can't think of them as in terms of forever stocks anymore. Occidental is the most forever-y of our oil stocks. And it's the most forever-y for a couple of reasons. One, big fat dividend, pretty low debt. They produce out of cash flow right? They're not borrowing money to drill. They don't need to produce cash flow. There's buybacks out there. So I just think,
and they're in the Permian.
And they're loaded in the Permian, and then they have that carbon mitigation business.
Yeah.
And I think that's the one that has nobody prices that in. I haven't seen it in people's models or anything. They have a business, carbon mitigation business. I don't even completely understand it, but I get the gist of it, and that's going to be a big deal because, again, the policies are moving in a certain direction. The secular trends are moving in a particular direction, and even though we're going to see continued huge growth in alternative energy, the reality is that we need fossil fuels for the next 10 to 20 years for sure, and maybe even for 20 to 50 years. Hard to know. It is, I was watching the CEO of Exxon was on CNBC or Bloomberg yesterday, and he was talking about people just don't grasp how big the global energy system is. And I think that's probably true. So let me give you an idea. So let's take a look at XLE. Let's take a look at the holdings. Exxon. $320 billion. Chevron.
Majors.
Right? $226 billion. As you go down this list, even as you get down to Devon, $12 billion. Add up all of these billions and then throw in Total, Eni, Royal Dutch Shell, the Russian companies, the Saudi companies, all the other companies from the Middle East, right? China's got a couple of giant oil companies. When you add this all up, it's just massive, right? So think about what the natural gas bills are going to be in the United States in the next month. I mean, it's been -5 and 10 and 20 degrees here in the Midwest for a week.
Well, next week I think it's supposed to warm up a little bit.
Yeah, well,
it's kind of fluctuating a lot.
I'm turning my heat up to 90. Just to get my
keeps
bones.
running. Yeah.
I just want to get my bones warmed up. I mean, I was outside for 5 minutes yesterday, and I was like, my fingers barely moved. So, and plus it's going to get cold right after that. We're only going to have a few days of warm weather, and then it's going to be zero. So
get a little break.
How cold is it by you? You're near
Philadelphia, we had the past couple of days overnight it did go down to the single digits.
Yeah. I just know that we've had record lows for a while now, and it sucks. But that's a lot of natural gas that's getting used. So
definitely.
Anyway, we'll take a look at the natural gas storage numbers and see where that goes. All right, so let's move away from energy. We talk a lot about energy, but the reason why oil and gas aren't going to subtly disappear is that we just need them too much. And we're just going to have to gradually move away from the fossil fuels or come up with an amazing technology to cut the CO2. And it's gonna be an all of the above answer, right? We're going to move away from coal. We're going to move away from oil, but not all the way. And it's going to take a long time. And there's going to be technology to get better mileage out of cars, and all these moving parts. So just understand the big trend. And I think energy you can trade. Accidental petroleum, I think you can hold, probably for a pretty long time. This is a stock that I could see owning for a decade. Most of these other stocks that we're in, I've said 2-3 year holdings, and we'll see. So those are trades. So let's take a look at some longer term holdings. PayPal. I've been talking about PayPal since it IPO'd, and Dave recently did some work on it too. So Dave, why don't you tell us just in 30 seconds why we should think that PayPal is going to bust out?
Well, I think right now, I mean, they're they're a toll collector. That's the way I look at them, like credit card companies. They're collecting fees, basically. And they don't have a whole lot of expenses that hold them back. So I think basically, and then for the future, what we're looking at is they could be involved with, they have a blockchain test that they're doing with their own employees, or they allow their employees to kind of use the blockchain technology. And I think what that could be setting up could be a kind of a test or an experiment to see how that works for getting closer to bank-to-bank transfers. That's the theory. So we don't know for sure if that's going to take place. But even without that, I mean, just they're collecting fees and growing their core business is going to be a good catalyst. But the kind of the thing that's not priced in is the potential for their use of the blockchain going into to be used for bank-to-bank transfers in the future.
Right. So that's just the quick thesis. So we have to ask ourselves, does the market agree? Well, so money flow went up and it's pulled back a little bit. MACD's turned over a little bit. It didn't get overbought, but it got close, but it's come back a little bit. So let's take a look at these short-term trends in light of a longer-term trend, right? Started to consolidate here. The likelihood, because it's down here, is that it's going to break back up to these levels. So at some point, the next year or two, maybe sooner, this is going to go up here. So always take a look at the shorter-term trends in light of the longer-term trends and try to see, okay, if we were up here right now, a pullback would be indicative of saying, we're probably going to see a series, right? But when we're down here, a pullback is kind of a buy the dip thing. So when we've had a long period of things being good and it starts to pull back, probably indicative of more pullbacks. We've had a period of consolidation and we get a little pullback after a rise, probably indicative of just a pullback. It's a dip to buy. And I think that's where we are on PayPal. I think you can definitely buy the dips on PayPal down into the middle 80s, somewhere in here. You should be looking to buy PayPal if you don't already have it. And I think at some point, just because of the massive amount of money, so this is where the fundamentals come in, all that money they're making on the tolls, right? Every time you do a PayPal transaction, PayPal gets some of that.
Yeah.
They're going to shoot up. And they're becoming much more entrenched in not only websites, but in the cell phone payment systems. They're going to move into all the same. Square and PayPal are going to be do all the same things, but PayPal has enough infrastructure and lead on them globally to do a few more things. Mm-hmm. And so I favor PayPal over Square because I think Square has been a darling and it's overvalued, and I think PayPal has consolidated nicely. And a new buyer would say, okay, I want to get in on this because it's probably going to do the Visa MasterCard thing. Mm-hmm. And, if you've already owned it for a while, be patient. If you haven't made much money, if you're only up 5 or 10%, because the next leg up is probably coming. And they have catalysts where this could be a moonshot. Could be. We don't know that it will be, but it's a very good stock that's probably going to go up. And it might go up a lot, right? And that's a great equation. Not a lot of downside, probably going to go up, probably going to beat the market, might crush the market. And if you own a lot of stocks that follow that criteria, a couple of them will crush the market, and you're going to have outsized gains. So, and here, I want to take a look at Exact Sciences. And I want to give people a 10-year chart. In fact, I'm going to go back to when I bought it. All right. So I bought Exact Sciences way back here.
Nice.
At $1.65. All right. Chop it.
Have to be patient.
Well, but look, I bought it at $1.65. And 1 year, 2 years, 3 years, 4 years, 5 years. So in 5 years, it went to 10. Does that suck? No. No. But there were periods of time, and especially if you bought it at 5, or let's say you bought it at 9 and then it dropped down to 5. Oh my God, it went from 9 to 5. I lost half my money. Buy more. You know the story. And then this is where Medicare and FDA gave it approvals. Bam, $30 a share. You know how much money I made on these calls? A lot of money, because I bought calls ahead of the FDA and CMS announcements, right? Because I paid attention to my stock. Made a bunch of money, took the profits on all the options, sold about half of the stock. It dropped down to about 20. I started buying it right before it fell down to 12. I was like, oh, God damn it. And then it chopped around here and got all the way down to $5 and $6 a share. And at that point, I'm like, okay, it's going to hold 5 and 6. And the CEO bought a big hunk of stock. And so I started buying even more stock. I refilled my position. I doubled down. I bought leaps right in here. Bought leaps.
Awesome.
And I sold pretty much everything at about 60, 62. Right in here is where I sold. And I've been selling puts periodically all the way up. But I even told people right around in the 70s, probably start taking your profits. So sell the rips. And I would even tell people now to sell this rip. So if you own Exact Sciences, and I know some of my long-term folks still do, I'd really be selling this. There's not a lot of breakout here. And news, the fundamentals that you have to be aware of is while the Pfizer deal will help them penetrate the market more, they have to share the money with Pfizer. So they shortened up the time frame that they would, get a lot of the market share in colorectal cancer testing, but they're giving up some of their profit. So it was a trade-off, right? We can do it ourselves over a longer period of time and make all the money, or we can get it done faster and make some of the money. And they still get a big hunk of the money, but I just think that they've kind of capped themselves a little bit. And so I look at Exact Sciences, and there's a whole bunch of what ifs with the company. What if they come up with another great test? But their research and development has been hit and miss. They've got some things that I think are going to come to the market, but there's a process involved with the FDA. I'm not saying that Exact Sciences is a bad company. I think it's a very, very good company, but it's not a home run anymore. This was the home run, and this is one of those second chances, which you don't always get, which you actually rarely get. But you had a chance if you were buying in here, and you went from an average price of 5 to 30 in 5, 6, 7 years. That didn't suck. And then if you got a chance to buy down between 12 and 5 again, and you started selling at 60. And maybe trim and then get rid of more in the 70s when I wrote that last article. I'm telling you probably take some more profits now, because this is just not. This volatility is indicative of uncertainty and higher risk. And even though the traders can push it way high, the traders can push it way low. And if they break through this, I still think Exact Sciences can see the 50s again. And I'd point out that a year ago on our very short list, and all the subscribers will be aware of this, is I had very, very low bottom fishing prices on a lot of our holdings or a lot of our watch list. People are like, this stock is twice as high as your bottom fishing price. How am I ever going to buy it? I said, wait. At some point, we'll get a big correction and you'll buy it. And what did we see? We saw Google come all the way down to around 1,000, which is almost to my bottom fishing price. We saw Amazon come all the way down to around 1,500, which is my bottom fishing price. All these great. All these stocks came down to bottom fishing prices in December. Should have been loading up the cart. And I just showed Dave my portfolio. What's my biggest holding right now? As an individual stock, it's Google. What's my largest holding as a fund? It's XOP. But I own a big hunk of Amazon, which I'm still up on, but they took away most of the profits today. PayPal, First Solar, and Apple. Although I will tell you, depending on what fund I use in the technology sector, I don't know if I'll hold on to Apple. The reason being is that when you take a look at XLK, Microsoft and Apple are such huge positions that I probably don't need to own either one of these stocks individually, because I think they're market beaters, by a little bit, but I don't think they're home runs anymore. But they pay a little dividend, and they're going to be dominant in their spaces, and they're going to do okay. Not a lot of big regulatory issues with these guys, like you see with Facebook. So I think I feel okay with this. And they pulled some stocks I don't like out of here and stuck them over at XLC. So I will tell you, I don't like Facebook, not even a little bit. I don't like Netflix. Dave disagrees with me.
Yeah.
But I think Facebook's regulatory hurdles are a big deal. I think they're going to have a very difficult time monetizing things more than they already have. And I just think that I talked about this way back when they IPO'd, right, about 3 months after they IPO'd when they crashed. I told everybody this is what Facebook can become, but in the long term, I think Facebook is going to become kind of like that old kitchen telephone book that you had laying around by the old corded phone, right? For those of you who remember phones with cords, Dave's too young. He doesn't know what a phone with a cord is.
Oh,
right? You're like 20.
I had the.
Aren't you like 20?
Slam this, man.
But aren't you like 24? You sound like you're 24.
No. I'm 47.
Oh, that's right. We're
48.
We're the same. We're the same age for another 5 days. For another 6 days, we're the same age, and then I'm 49. But so I'm not a big fan of Facebook. I wrote that article that they were going to take it on the chin, and they did. I haven't written an article about Netflix. I've just ignored them. I think Netflix. And remember, when the market wiggles around, that is the result of aggregate opinion, sentiment, right? So Netflix had this big rally, and now it's turning over. What's going to happen next with this one? They hit overbought, right? Look at that. But the trend is down. I tell you what, boom, 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 boom. I think you see Netflix all the way back down to here. So what is that? Real close. Around 200. Low 200s. I think the shorts on Netflix are going to get this one right. Next time the market gets weak, and I think you could see one of those waterfalls down. Now, would I buy it around 200? I don't know. Maybe Dave's thesis that they're going to keep adding revenue is right, and by then we'll have evidence, and maybe we could buy it around 200. But I think that there's a lot of risk here. I don't like that at all. I don't like some of their key stats. I just worry about these guys. Where's the debt number? Find debt. It's a lot of debt. And they have to keep on to produce their own content. They have to take on more debt. What if liquidity gets tighter? Right? I think these guys could have some problems. Now, they could end up kicking the crap out of Disney and HBO and everybody else that they're going to be competing with in the next year. The Disney service that's coming out is going to be a big deal. Disney's a company that I keep
I like that
around.
too.
They never get cheap though.
Mm-hmm.
I think
hold a certain level.
Yeah. So I think to buy Disney, it's always right around 100. It's been around 100 a long time. I think to buy Disney, you need a correlated sell-off, but even in this last Chihuahua does not like the garbage man outside. It's been chopping around. Yeah. But 3 years, look at that. From about 90 to about 120 for a very long time. 5 years. 10 years. It's 5 years.
Well, that's the concern about ESPN.
Yeah. Because their contracts are huge.
Yeah.
So what is the catalyst for Disney to break out of this box? I think it's going to be their streaming services.
Plus they have Fox.
That's right. Their content library is awesome. So I think that it's going to be successful. I'm more likely to buy the Disney service than Netflix. I already got rid of Netflix. There's nothing on Netflix I need. Every now and then I'll watch something with a girlfriend. And that's another thing. I mean, if I have Netflix or Disney and my girlfriend has Netflix, it's just, there's going to be more competition. More competition means that the leaders are going to take a step back and the up-and-comers are going to make some of that money. And that's what I think causes Disney to break out. Plus, their franchises are just so strong. So, who's to say that they don't unburden themselves of of more of their assets, right? And maybe ESPN belongs on its own.
Yeah, it could be split off.
Yeah, so we'll see. Maybe ESPN just, they're already kind of doing it via the web. I think we need to kind of see where this box goes. I don't think it's very likely these guys tank.
No.
But I think that this box is a consolidation. It's kind of moving in the right direction.
Kind of waiting for that catalyst.
And if you add it, that's right. If you add a catalyst, zoom. So I think Disney is a stock that you buy every time it's under 100 at this point. I mean, barely budged. I mean, this correction did not beat the heck out of Disney. I think it's because a lot of people are thinking the way we are. Now, what if Disney took 3 or 4 or 5 years to get out of this range, but then all of a sudden went to 200? And in 5 years, you doubled your money, but the first 4 you were breaking even. Would you be disappointed?
No, I don't think so.
I don't think so. And I don't think there's a lot of downside risk here if you're buying in the 90s. So keep that in mind. All right. Let's do 1 or 2 more and actually do an hour-long show today. We're looking for ETFs to have good exposure to technology. We already looked at XLK somewhere. We looked at XLK. It was probably in here, wasn't it? And if you don't want to own Microsoft and Apple as individual stocks, but you want exposure and you want tech, then XLK is probably a pretty good one. But I did some charts. I guess I'll have to do it again. I must have squished it. All right. So I don't like this XLC. I'm going to be selling this because I don't like Facebook and Netflix. If you like Netflix and Facebook, then go ahead and buy this because I love Google. I like AT&T. Just talked about Disney. These are all good companies. 5G, CBS could get taken over. You got these guys with all the content. Discovery is always doing well. News Corp. This is a pretty darn good ETF if, in my opinion, to have so much, 20% of it wasn't Facebook and Netflix. So, take that for what it's worth. Dave kind of likes Facebook and Netflix. I kind of don't. I don't hate either one of them. I just think the home run has been made in both of those. So I don't think that they add much to it. So it's almost kind of like, you know, if I'm trying to beat the market, why do I want stocks that are just going to chop along and maybe get beat up?
Or if you look at Netflix, I mean, let's say we have a recession. Are people really going to, you know, give up that $10 or $15 a month? You know, even if you're unemployed, you're probably going to still be watching movies and shows.
Here's the way I think of it. So the show that kept me in Netflix was House of Cards.
Mm-hmm.
I can get all the other content pretty much anywhere else, as far as I was concerned.
Mm-hmm.
So if they don't have,
what people watch.
That's right. For somebody to keep Netflix, because it has no value as a movie provider, it has to be you're into one or two or three of their shows.
Right. Mm-hmm.
And I didn't even watch the last season of House of Cards. I don't even know what happened. I don't know if anybody cares. Did they even do the last season of House of Cards? I don't even know. So
I don't watch that one.
Yeah, I thought House of Cards was awesome. And then, you know, Kevin Spacey decided to be a weirdo. So, you know, and you know, so the show got wrecked. But I'm not hooked on any of their other shows, and I think that in a world where the millennials want experiences, I just don't see content I think content has to have that hook, right? I don't think a lot of people are sitting down in front of their TV on a regular basis. If there's a show that they want to watch, they'll watch 3 episodes tonight, 3 episodes tomorrow, and 3 episodes on Sunday, and they'll be done with the season. And if Netflix isn't putting out that kind of content, then they're going to have problems. Okay, so they're going to try to put out that kind of content, and that costs a lot of money. And they have to compete with Amazon, and they have to compete with Sony and Disney, right? Hulu just came out with a deal where they're only going to charge $5.99 a month. So now there's downward price pressure, and that should be a signal to everybody. If they're already doing price competition, right, from $12.99 a month to $5.99 a month, what does that tell you about their pricing power? I worry about it. So I'm not super excited. But I own AT&T individual stock. I think I'm going to find a way to get Disney at some point. Verizon looks like it might be coming back to us. So we've talked about Verizon in the past. They could be the best pure play on 5G. They just got hammered. They're down to their 200-day moving average. So let's take a look at MacDaddy and take a look at shaken money flow. All right. Kind of, you know, good trend here. Got crushed, coming back. Why did Verizon get crushed? What was the fundamental news? But then all of a sudden stops at the 200-day moving average, right? Could have been that bad. So we'll take a look at the longer trend. Looks like it's bottomed out. So I think this is probably a dip to buy once the daily has bottomed. So this money flow probably heads down into this range, right? We can see that it happens. So when the money flow gets down to like right around 0, probably start buying it up. And you see this blue line start to turn up, right? MACD starts to turn up, and you're probably at an extreme. So look for those extremes with the turning points. Give it a day or two to confirm, and then you can probably buy. So my guess is that you should be buying Verizon in that 53, 54 range. So maybe only about $1 below here. Now, is there a possibility, you know, that they come all the way down to these longer term support levels in the 40s? Yeah, sure. You know, so if you buy at 54, make sure you hold some cash to be able to buy, you know, at 44 as well. A big fat dividend. That's a little high, but all these companies are capital intensive companies. But they also have massive revenue, and that revenue isn't going anywhere because who's getting rid of their cell phone? Dave, you can get rid of your cell phone?
No, I don't think so. Once I get a new one.
You're not getting rid of your cell phone. All right. So, you know, I think that Verizon's a pretty safe company, and if we can get it at a at a, maybe a buck below this price, and then have some cash on hand if it gets into this range, then there you go. Now, bottom fishing price is probably about 44, 45. I don't remember. But is not, I'm going to finish with this. It is not a bad strategy to only buy at bottom fishing prices. It's actually a great strategy, but you have to be patient. You have to not have FOMO, right? Don't have this fear of missing out. Right? So as we go through the dividend stocks, oh, where did oh, Verizon's the Dow Jones, isn't it? Yeah. So you got Verizon. There you go. $44 bottom fishing price. Which stocks in the Dow Jones are near their bottom fishing price? You've got IBM and DuPont. So let's take a look at, first of all, let's kill some of these tabs. It drives me nuts. Actually, Dave wants us to look at something. Here's the holdings again. We already kind of touched on this. There's another one. We have a sister one.
That's right, RK.
This is a little broader. 3D printing, can you imagine that? Everybody thought these guys were going to die. Take a look at this, and you go, okay, kind of a good list. But now take a look at this one. Look at how it's spread out. These are the software companies. Now, let's take a look at a chart and compare ARKK, ARKW, XLK, QQQ, and that's probably fine. What does that tell you? Which one is this? This is your web company one.
Yeah.
Now, do you think it's going to keep doing that?
Yeah, I think it's going to be up there. I mean, I don't know if it's going to be ahead of all of them. But
look at the last year.
Well, I had a big year prior to last year, but I think 2017. So it's probably consolidating a little bit.
All right, so over the last, about 4 years, as far back as it goes, these guys kicked butt on the back of what? Netflix, the FANGs. The FANGs. I don't like two of the FANGs anymore. If you like the FANGs, then this is probably pretty good fun for you. Look at this blue one. Technology. Software. Last year, look at the blue one. So over a longer period of time, the blue one is near the top. Shorter term period of time, blue one is near the top. I kind of like this fund here. I like this expanded software play. And I don't think there's a fund that's there's no magic solution for a fund, right? It has to do with what do you want to be your asset allocation. And you can measure all sorts of different things. The Invesco utilities did pretty well lately, but if you take a look at 5 years, nowhere to be found. It's all semiconductors. So if you had a software and a semiconductor fund, that might be a pretty good combination. If you really want FANG stocks, then that ARK W, pretty darn good, pretty good one. So you can do almost anything you want with your asset allocation, but when you take a look at any fund, you really have to take a look at the
All the
underlying
holdings.
hold. Yeah,
Yeah.
yeah, and decide, do I like some of those underlying holdings? Because if you don't like two or three of the top holdings, why would you own it? I'm not a big lover of Broadcom. I think they've had their run. I think they made their money on buyouts, and I think that it's going to be hard for them to do that in the future because there's nothing big enough for them to buy out anymore to move the needle. I think Qualcomm's got a value to their patent portfolio. It's hard to pinpoint. But I think Intel and NVIDIA are going to do really well going forward. So the question becomes, okay, how do I get a piece of Intel and NVIDIA and Micron? Do I just buy those stocks and create my own little basket? I think that might be a good way to do. Put 2% of your money in Micron and NVIDIA and Intel, and now you have a great little basket of semiconducttors. And if you know something about two or three of these, go ahead. Skyworks hits the radar all the time. Marvell hits the radar all the time. Like I said, I'm just not a big fan of Broadcom. I think Texas Instruments is a good retirement income stock. But if I'm a growth person, I don't know that I want Texas Instruments. But if I'm a dividend income investor, right, I think this is a pretty good one. Yep. You take a look at their box. They're in this box. So if you buy near the bottom of the box, in the 80s, you're probably going to do really well. If you buy near the top of the box in the hundreds, so it becomes a matter of, where to buy, which is why I said it's not a bad idea to just shop the bottom fishing prices. Is Texas Instruments not in? Okay. So Texas Instruments should be in here. There you go. Bottom fishing price 63. I might have overstated on that one, but definitely in the 80s, I think you could probably buy Texas Instruments. If we had a really big correction, you know what? I should probably update that. I think I'm probably wrong about that. I think probably 83 is the right number. It's going to be hard for them to get down into this range. We'd have to really have a big correction, right? I think unless there's a financial crisis, I think you probably buy these guys in the low 80s. So we'll talk about it more. But all right, anybody else? What did I think of Amazon's earnings? I think it's a buying opportunity. I think anybody betting against Amazon is insane.
Yeah.
So, this is the market trying to. I tell you, in a thinly traded market, and it's not as thinly traded now as it was a while back, and it probably won't be. In fact, I'll tell you what, the way this year is shaping up is that it's probably going to be a pretty good up year. And I say that because we had that big selling in the fourth quarter, and with all the new money coming in, if the hedge funds are up going into the end of the year, if the market is basically up going into the end of the year, you're not going to get the tax loss selling, and the hedge funds will stay in business, right? Hedge funds only go out of business in down years. So in an up year, all that money stays in the market that came out at the end of 2018, stays in it 2019. So the year that becomes the question mark is 2020. If I, feet to the fire sort of thing, if I had to make a prediction, I say that 2019 is going to be pretty good. You should be buying the dips. And there's going to be dips in the next week or two, probably be some dips in April, due to the buyback, gray out, brown out, whatever you want to call it. When buybacks slow down, the market dips a little bit. And the Fed is already backing off on interest rates, and I'm pretty certain that they are willing to reduce the quantitative tightening if there's anything that goes on. So since I mentioned the Fed, let me just bring that up here and say I think it is very likely. Where does that money go? I lost him. Oh, there he is. I think that they're going to allow a little bit more inflation if they can get it, because the whole demographic overhang and the global debt picture, which is not as bad as 2007-8. The nominal numbers are, but the percentage of actual assets is not as bad. And there's better counterparty risk out there. So we're probably pretty far from a financial crisis. Probably sometime when the last baby boomer is just getting onto Medicare, that's when I would start to get scared, that's like 2027 or 2028 or something. So I would think that a lot of these doomsayers, and I'm going to write a lot about this in the next several months, a lot of the doomsayers, these guys that run around just saying bubble, 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 bubble. There's a guy that I know, and he's not really an economist or an analyst. He just ran around saying bubble, and he's been right once so far in 15 years.
And
that's
how they get their attention.
Yeah,
negativity.
Yeah, and I don't want to say the guy's name, Bubble Bubble, but or the Bubble Bubble, as a hint. But he's wrong, and he doesn't understand what he's talking about. Decent enough technical trader, but what have I said? People who are technical traders who try to give you a fundamental outlook, come on, just laugh at them a little bit. Humor them if you want to, see what other dumb things they say, but a real technical trader, a guy like Avi Gilbert, he'll just tell you flat out, I don't give a crap about the fundamentals. Don't ask me about it. I'm a technical guy, and I'm good at it. That's fine. I respect the hell out of that.
Yeah.
But if you're a technical guy or a technical trader, then you try to tell me what the fundamentals mean. Heck, that is a kiss my ass sort of moment. So, in any case, the fundamentals, everything is shaping up to be strong right now, but the long-term overhang are deflationary forces. And the timing of these deflationary forces hitting us is suspect. We don't know exactly when. As more and more boomers get onto Medicare and Social Security, that's when the financial problems become more acute. So will we solve the problem that's 10 years out today? Probably not. Will we settle it and fix it in 2 or 3 years? Probably not. When are we probably going to fix it? When the crisis comes.
Yeah,
Why?
exactly. Yeah.
Because we're dumb that way, right? So, between now and then, there's probably some spectacular rallies. Because in a changing environment, it doesn't matter what the change is. Anytime there's a changing environment, there is gigantic opportunity. And the changing environment now is technology. It's AI. It's the smart everything world. It's alternative energy, smart grids, smart cars, self-driving cars, augmented reality, which has amazing applications to automation and industrials and healthcare. So when we take a look at these things, the linchpin, the thing that pulls every industry together, it's technology. And so we need to keep an eye on that and understand those big trends and say, okay, where are we going to get investments that help the dividend growth investor? Some of them are here. And where are we going to get investments that could be home runs? And then some of those are over on our growth stocks list. And there's 20 more that are going to hit that growth stock list. So you can expect this growth stock list to become a lot more smaller cap and mid cap. And this technology list to expand probably by double this year, because there are massive opportunities out there. Everybody's, Lumentum is finally at the bottom fishing price. I know people bought it higher, but I put a bottom fishing price in for a reason. And now all of a sudden, look, it's just about there. So the people who already bought Lumentum are like, oh, God damn it, Kirk. But the reality is that I said, look, it can go this low. You could have waited. So, I think it's a stock to take a look at now. Because I don't think Apple is doomed. I don't think they're the home run, though. I just think Apple, if you're a dividend income investor, buy Apple. If you're a growth investor, Buy some of the suppliers to Apple because you're getting them on a down cycle. What happens after a down cycle? At some point,
it's an up cycle.
Yeah, hey, we don't know exactly when. We can tell you it's going to happen. Can't tell you exactly when. So keep an eye on the cash flow, right? Where is? Don't have any technical charts up anymore. All right, we're going to finish with Lumentum just because I mentioned it. I think this is a good one to take a look at if you really want to just take a look at, okay, where are we on a company that got crushed, right? And they got crushed because they're a large supplier to Apple, but they've diversified now. And since they bottomed out, look at that.
Money flow coming in.
And then look at that. Okay, this gap's going to fill. This is going to go back to 54. Will it go back this time? I don't know. Could it pull back to 44? I don't know. But this tells me that it's probably going to hit a turnover, but by then it might be 54. You know, hard to know. So take a look at these longer term trends, right? This is not a hated stock. This is a stock that people want to accumulate, especially since it bottomed. I mean, look at that. I mean, that's perfect. That's perfect. You know, people, well, look, it's not going up. Oh, gee whiz, man. Longer term time frames. Because when you get one of these, look at this. Zoom. 25 to 45.
Nice.
Chop, 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 chop. Zoom, 65. Eked out. Came down. Gap. The gap's probably going to refill over here somewhere. And then how high can it go? Well, how high can it go depends on the fundamentals. Okay? Low debt. What are their revenues? How much free cash flow do they have based against market cap? You know, I like these guys. And I think that if they can keep getting growth, they're going to be in good shape, you know. So their trailing numbers are horrible. Suddenly, as management told us, they're starting to turn the ship around. So I think Lumentum is maybe something we take a look at. It's close to its bottom fishing price. It's had its big problem, and now it's getting better. So, all right, that's all I got. We did not make an hour again. All right.
I think you did last week.
We did last week? We were under an hour last week?
We were close, yeah.
Well,
I think question session may have gone a little over. But.
Oh, yeah. So, and people asked last week because you and I stayed on the air after we turned it off. That's okay, folks. We were just talking about things we were going to work on. And, you know, it's cool if you guys want to listen to that. We weren't telling any weird stories. That nice one by the Bucks last night. Yeah, Bucks, tell you what, I don't know if the Bucks are really a title contender or not, but they sure are fun to watch. They remind me a lot of Golden State without all the big stars. But Giannis, tell you what, I don't know how you stop Giannis. I have no idea. And with all those guys around them, if they're healthy, if the Bucks are healthy, particularly Brooks Lopez, when Brooks Lopez plays, the Bucks win. And you know, I'll predict it right now. Bucks and Golden State in the championship. And if Brooks Lopez is healthy, the Bucks win it. How's that? I'm not being a homer there, am I? Maybe a little bit. I don't know. I don't know basketball that well. I just like watching it. All right, everybody, have a great weekend, and I will report back to you from the World Series of Poker in Milwaukee, and hopefully come away with a little bit of cash. Take care, everybody.
Yep, take care. Have a good week.
Yeah, bye.